the market may not line up perfectly with where you're or when you're entering the marketplace. And so you have to be very, very, very cognizant that the day you are ready to buy, the market may be doing different things. Economics is not stagnant. So it's very important to have a long-term viewpoint when it comes to property investing. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, code-cracking stuff. Yes, we're going to dig into short-sighted investment. Wow, does that sound riveting? Let's not be short-sighted when it comes to investment. That could be the end of the podcast. But no, we need to understand some deeper layers. We're going to dig into, for example, risk-adjusted return. So you're not short-sighted when it comes to being a property investor. So I hope that sounds riveting. Welcome back, regulars. You know the drill. Play the program in double speed, get your life back. And of course, all the episodes I've done are lessons on real estate. So you're more than welcome to scoot around. But I don't think I've done a lesson on risk-adjusted returns and really the concept of short-sighted investment. So I think it's a worthy topic. And I feel worthy today. I'm going to get an injection later today. Yes, my body's being injected with vitamins. Has anyone ever done the vitamin drip? I've never done it. I'm going to vitalize my body. I've thought about it and I feel like I need more vitamins. So I've decided to intravenously, if that's the word, inject vitamins into my body. And Rafi's got a tick. Yes, he's half dead. He's going to make it. But between Rafi being half dead from a tick and me revitalizing my body with vitamins, it's a bit of a seesawing effect here in the Saggers household. But what we are not short-sighted investors in this building, in this home. We are long-sighted investors. So in real estate, there's a concept known as the filtering theory of property. And really what it is in real estate, as the better areas get purchased, the risk for property investors increase because there's only so many good areas, good streets going around. And if someone else owns them, then to get those properties in those good streets and good suburbs and good locations and lifestyle precincts, you ultimately have to pay a pretty penny. And so what happens is there's this concept of filtering theory. It filters down. I may have spoken about this before, that the idea that property investors who are shopping on a budget ultimately are pushed into a corner where they're quite often having to buy in marketplaces which are far more speculative than they may like, and even property types which are far more speculative than they like. As property investors tend to shop on affordability, they tend to also need to consider the risk-adjusted results of what they're trying to do. And again, like as we're pushed into more speculative areas, we need to be more careful about how we approach investing. And I have seen this a lot of late, that people get themselves an approval from a bank and all of a sudden they're lit up with energy to go and buy real estate and quite often shop on a budget. And I see that people will often not even shop on the maximum amount they can spend. And of course, there's a lot of short-sightedness to that in itself. if you've got a pre-approval for $700,000, $800,000, you should try and maximize that spend. I don't have a pre-approval for $700,000, $800,000, then go and buy a $500,000 property because you feel more comfortable in that dynamic. Obviously, anxiety plays a part with investment, and there is also a concept known as anxiety-adjusted returns. In other words, if you can feel safe doing what you're doing, you're going to hold real estate longer and get the ultimate result. If you feel terrified and anxious, you will get a return that is based on that feeling. But ultimately, real estate is about deploying capital and putting it into the market, and your buying power is an asset. If you can get a good level of buying power, you're going to have to speculate less and invest more in real estate. Yes, speculation and investment are two different principles. And really what I see a lot of is people having to speculate more as the affordability metric starts to leave the marketplace. And what happens is people's short-term situation comes into play. And a short-term situation is effectively you're in the market at a point in time. Now, when you decide to get into the market and your stars align, your tax returns are done, your income's perfect, you've got equity, you've got the ability to jump into the market may not line up perfectly with where you're or when you're entering the marketplace. And so you have to be very, very, very cognizant that the day you are ready to buy, the market may be doing different things. Economics is not stagnant. So it's very important to have a long-term viewpoint when it comes to property investing. And that is where a concept known as total return or value investing is very important to understand. When it comes to real estate, we want value-driven real estate investments, and we need to also apply some risk as to where we're going to invest. And so I think what I see a lot of is really short-sighted investment, really people ignoring market cycles and chasing fads. You know, if you wanted a good market cycle, which has got a lot of upside left in it, you could be, for example, still shopping in the Melbourne economy. It's ridiculously inexpensive for the value you get, the intrinsic built-in value you get in that marketplace. Fads are certainly more speculative markets. They might be the same price as Melbourne, but they've got a completely different risk profile compared to Melbourne. And so we can adjust the returns for a more risky market to a safer market, and we can start to work out whether it's actually better to go to a riskier market as long as we get the extra reward for doing that. It's risk versus reward game real estate. And again, short-term investing or short-sighted investing is really chasing trends, neglecting fundamentals, focusing only on appreciation, ignoring market cycles, and lacking the understanding of the power of compounding growth, i.e. buying a substandard property in a substandard location just to get into the marketplace and to appease a finance approval. So short-sighted investment versus long-term investment is two distinct differences, or has two distinct differences. Short-sighted investment is just about getting into the market. It's about being part of the investment community. And it's really often done through a lack of knowledge and or investment fatigue. The decision criteria of short-term or short-sighted investment is quick analysis, quite often just hearing something and creating a personal bias around it, seeing some things on social media that look exciting, hearing a result somewhere and going, wow, I'm going to get that result too. And all of a sudden, your decision criteria is really based on some sort of emotional kind of feeling about something. You're feeling-based investing. And of course, when you go to the wrong marketplace because of trickle-down property theory, and all of a sudden you end up feeling that you're going to get the result, because when you look at the price, you go, wow, it's only $480,000 for a house in that suburb. Wow, everywhere else in Australia is $1 million. You all of a sudden put yourself in a much higher risk category. And that risk from short-term positioning is local market volatility, a misguided acceptance of some sort of substandard trade-off. And so it's very important to quantify the rules around how you invest. And of course, an example of that could be a property which is in a suboptimal city, in a suboptimal marketplace, in a suboptimal suburb, and the condition and impositions on the property are, pretty beat up. And so if you are thinking that's going to get long-term growth, you are misguided, because the regularity of growth hitting an asset that I just described is going to be very, very low. The compounding effect of growth on an asset like that would be very low. Could the market go on a run and the asset shoot up in value by $100,000? It absolutely could. But will that $480,000 property, which now you get a quick hit, it becomes $580,000, is it going to go to $1 million? Is it going to go to $1.1 million? And what happens is people trade short-term boosts in real estate as opposed to investing for the long term, looking for the fundamentals. And you see this a lot, like fads come and people make a little bit of money out of real estate, and then the music stops, and then they all of a sudden comprehend that though they've made money on a property in a short period of time, they are actually a long-term investor. And all of a sudden the music stops and they're stuck with a C-grade asset where they've made a small gain. And the C-grade asset doesn't go on to get regular levels of capital gain. So the opposite of buying properties with trade-offs in suboptimal markets, suboptimal locations, where the condition and any impositions on the property are going to hold it back, is acquiring a high-quality property that can grow steadily over time, steadily over the decades of your ownership. It'll get regular market demand and regular capital growth. In other words, every 4 years or so, it's going to get a growth spurt. And it really doesn't matter if the market's booming, because the real estate carries with it more long-term fundamentals of regular demand fueling the property's growth. And quite often I see people swap short-term metrics for long-term metrics. They want the quick hit, and the quick hit is almost like a way of justifying buying real estate that people really crave for. And I see this a lot. The worst thing that can happen is when you buy a C-grade asset and then you actually get capital growth on a C-grade asset, then you go again and you pull equity out of a C-grade asset to buy another property, and all of a sudden that C-grade asset actually gets reconditioned by the marketplace in a less abundant period of the property market cycle, in a decline of the property market cycle, and people can go negative equity pretty quickly on C-grade assets, meaning they actually owe more than what the property is actually worth. And I've seen this before, where C-grade assets, they're cheap and cheerful on the day of purchase. They're very exciting for people to buy, but there's a lot of short-sightedness around the actual economics of the investment. So when it comes to trying to understand some logic around all this, there is a concept known as risk-adjusted returns, i.e. we need to get a higher level of return the higher the risk. And so if we were to think about market-adjusted returns for risk, we can define some categories. And again, you can come up with your own metrics. These are just some of the things I use. Market volatility. How much do property values fluctuate over the long term in the area you're looking in? Is there volatility? Is there previous volatility? Market volatility is a risk factor. You could assess population growth. Is the area going to constantly get population growth? If population figures slow, is there a reason for population growth to impact that marketplace? And of course, some of the regional marketplaces are getting population growth, but if the borders start to clam up, if politicians start to change the algorithm, will some of the more regional marketplaces continue to get robust population growth? You can define risk factors like economic diversity. How many different industries are in a place? You can define risk factors like liquidity. How easy is it to actually sell in that marketplace? You can define risk factors like overall market vacancy rates. How has the vacancy rate been trading in that neighborhood over not only 1 year, not today, not the short-sighted viewpoint of the lens of the last 3 weeks, but how about the last 3 years? How about the last 10 years? Obviously, you can look at vacancy rates and go, has it been a continuous landlord's market? Has it been a tenant's market for 6 out of the last 10 years? You can define the risk when it comes to your viewpoint on real estate. And of course, you can look at, for example, things like stability in that marketplace. Has it been a stable marketplace when it comes to stock levels, supply levels, demand levels, and so forth? And of course, if you were to use a scale then and go, I'm going to now rank risk, you can all of a sudden come up with a bit of a scoring system. Now, just for kicks and giggles, I just put together 3 marketplaces and assessed them just through common sense as low risk, medium risk, and high risk. I took a world city, that of Sydney, and applied Sydney ultimately has low risk in it because it's such a big place. Then I took a medium risk city, a place like Bendigo, which is a nice medium level risk marketplace. And then I took a very high risk marketplace, a place like Moree. Moree is a small town in New South Wales of circa 10,000 people. So you've got mega city, Sydney, you've got Bendigo, which is a sort of top 20 city, and then you've got Moree, which is basically a small town. Now, if you went to market volatility in Sydney, it's obviously lower than Bendigo and a lot lower than Moree. If you went to population growth in Sydney, it's better than Bendigo and it's better than Moree. If you went to economic diversity in Sydney, it's better than Bendigo and it's way better than Moree. If you went to liquidity, it's better than Bendigo and it's way better than Moree. If you went to vacancy history and you looked at the three marketplaces, you can assess risk in those three marketplaces. And then if you looked at stability, you can again drill into those macro levels. And again, you can use the same logic in a suburb and so forth. And so what you want to do is you want to rank the risks. Now, in my risk calculator, 1 is low, 10 is high. So if I went to market volatility of Sydney, it scores a 2. Bendigo scores a 5. Moree scores an 8. If I went to population growth, Sydney scores basically a 3. Bendigo scores a 6. Moree scores a 9. 9 is risky, with 10 being the most risk. So what happens is you can create an overall score of a marketplace. And in my algorithm, Sydney, once I added up all of the scores that I gave Sydney, and again, this is just using some common sense, some logic, but also doing a bit of research into the data. I calculated that Sydney's overall risk is very low at 2.3. Bendigo is a medium level market at a 5.8, and Moree is very high risk at 8.8. Now, when it comes to then applying what you should do around the theory of the trickle-down effect of property investment, if you were going to go into Moree, which is a lot cheaper than Sydney, you need to adjust your growth and yield expectations to be a lot higher for the risk of going into that marketplace. And this is where we need to understand a concept known as total return. Total return is just the yield plus the growth rate. So in real estate, it's common for real estate to basically double from total return in 7.8% at 7.8% per annum. So when you see 7.8% return from real estate, that is basically the capital growth rate and the rental growth rate. And so we round that up to 8%. So Australia's real estate marketplace as a total return returns 8% per annum. And quite often people misunderstand that as the growth rate. That is the total return rate. It's 7.8%, but I'm rounding it up to 8%. So what does that actually mean? Well, if you, let's say you purchased a property for $500,000 and the rental return was 4%, the capital growth rate was 4%, you're getting $20,000 capital growth per annum, and you're getting $20,000 rental return per annum, 4% plus 4%. So you're getting 8% total return, 4% being your rent and 4% being your capital growth. So again, we then have to apply a discount rate for the risk. If that's the Australian average and Sydney's discount rate is 2%, Bendigo's 5% and Moree's 8%, all of a sudden when we look into property investment in those targeted marketplaces, we can expect a lower return in Sydney for our investment, because we can risk adjust the return. And of course, we can anxiety risk adjust the anxiety return in Sydney. So for example, like you you would have to get a 12% return in Moree compared to a 7% return in Sydney to basically balance the investment difference. So in other words, if you basically accepted a 5-6% overall total return in Moree, you would be putting yourself in a lot of danger because you haven't factored in the market conditions for risk. And so the better the market, actually the lower overall return we need to put us in a position to win. So it's a bit counterintuitive in that respect, but that's just the way it works. Now, I was just explaining this to someone who texts me, Justine. Hello, Justine. Shout out to Justine. I'm rooting for Justine. I reckon she's not a short-sighted investor. She's got taking her time to choose a property very, very wisely. But again, like if you were going to buy in a smaller marketplace, which has a higher level of risk compared to a larger marketplace, then you've got to balance out the risk of the marketplace through the actual property you buy. So you want a very low risk property if you're going into a medium risk marketplace. And to assess the same concept, you would go, what are the risk factors you're looking for to basically ensure that you're adjusting for the return you're looking for in the more medium profile market. So you could, for example, assess location quality, property condition, the tenant risk, the rental demand, the vacancy rate, the building age, the land to asset proportion, the market liquidity of the actual asset, not to be confused with the market, overall market liquidity, but asset liquidity. So you want some things to consider. And again, like if I was to analyze a really good property in Bendigo and I analyze the asset risk, and then I go to Sydney and I go, well, Sydney's a really good market, but then I choose a really bad asset in Sydney, I am not going to de-risk myself. However, if I go to Bendigo or Moree, I would have to choose a very good asset to counterbalance the market condition. So the ultimate is obviously a really good property in a really good marketplace. If you're filtering down to a more risky market, you don't want a risky property in a risky market. You want a good property in a risky market, a liquidable property in a risky market. And if there's medium risk to the market, you still want a very good property. In other words, you can negate some market risk by making sure the asset is of decent standard. It's got good property conditions to it. Tenants like it. It's not some sort of slum house. It's actually really in demand in the local marketplace from that perspective as a property. The tenants are the type of people that are going to pay more rent over the time. It's got really good rental demand. The building's not falling down and it's not in, a substandard street. It's got good land value. That's what you would be looking for. And again, you could calculate an overall property risk score for the actual dwelling. So you could do a dwelling risk score and you could do a market risk score, and then you could apply the targeted return you would need to effectively buy in that area. In other words, a total return. But what ends up happening is people use short-sighted logic and effectively buy in a medium risk market or a high risk market, and choose a high risk asset or a medium risk asset. And of course, this is a big trade-off for the future wealth of that investor. And yes, of recent times, people have won on the the real estate lottery board, because there's been a structural shift in real estate, not to be confused with people having a market shift. The structural shift in real estate has been led off the back of COVID. We've had a structural change to money. We've had inflation. We've had a work from home situation, and we've had the flight to lifestyle marketplace. And this has soaked up a lot of growth at certain ends of the marketplace. And now we're seeing trickle down economics unfold. And of course, anyone entering the market at the moment who can't keep up with the affordability is having to weigh up where to go and buy. And again, I'm a big believer in just choosing what is available in affordable and lifestyle marketplaces. And if you want a nice, big, safe market that would tick the boxes, find a good property in the Melbourne marketplace, because it's still very, very affordable. And obviously, from a risk score, would score very low. Score very high. Score very low when it comes to its risk. Like it's going to get a good score compared to, the Sleepy Little Joe Village. So you've got to come up with some parameters to buy. And of course, what I see a lot of is buy the cheapie and hope for the best, which, I've seen over the years that not work out. So when it comes to choosing real estate, we want this total return. And to get that, you quite often need a little bit of intrinsic value in the real estate. And that creates this sort of margin for error effect in real estate. And, good location, good neighborhood, good amenities, infrastructure, good socioeconomics, good age of dwelling, size, design, and dwelling type. And remember, real estate is no different to the Monopoly board. Remember, on the Monopoly board, we've got that sort of start of the game, and you go sort of past the sort of browns and sky blues and kind of, Old Kent Road and so forth. That you're not going to get wealthy out of buying that end of the marketplace. I don't think anyone's ever won Monopoly just owning real estate at that bottom end of the marketplace. Obviously, you've then got your, and I would call those areas the disinvested end of town. There's just constant, lack of wealth coming to those areas. And so what I'm trying to allude to, on the Monopoly board, we don't want to be short-sighted and just trickle down to those places. Even if they're a fad. And even if you can make quick 50 grand, 70 grand on those, in those marketplaces. If you're a long-term investor and you're not planning on trading and flipping, then it's those properties won't go from $500,000 to $1 million. No one wants to pay $1 million to live in the hood. It's just as simple as that. And so then you've got your affordable section, which is your sort of pinks and oranges, and that's the affordability section of town. Then you've got, your more aspirational section of the market, which is on the Monopoly board, your reds and yellows. And then you've got the discretionary end, which is your greens and dark blues, which, the old Mayfair and Park Lane. So obviously, as a property investor, you're not going to, for most part, be able to buy Park Lane. It's not going to happen. You're not spending $5 million on an investment. So if we can find the affordables, that's really where investors need to position themselves. Affordable real estate that becomes aspirational. We want on the Monopoly board, and I hope you play Monopoly because I'm using the colors of Monopoly. You probably never played and you're going, what is he talking about? But if we can get those properties that are affordable, that become aspirational, we're going to do very, very well out of real estate. Now, there's a lot of advantages to value investing for the long term. Long-term capital growth, lower risk, consistent wealth, and that's going to require patience and time. And this is the thing when it comes to real estate investment. We need to always consider total return logic and apply a risk to that total return. Now, think about total return for a moment. On the income side of the equation, you've got your weekly rent, and then you've got rental growth. It's one side of the total rental income scenario. And then you've got depreciation. So they're kind of your positive attributes. Is the asset you're buying capable of depreciation? What is the weekly rent, and what is the ability for that rent to grow? Then you've got to offset that against rental costs, inflation rate, and the cost of repairs for the asset. Does it need a lot of repairs constantly or basically never? So that's one side of your return equation. And then you got the other side of your return equation, which is your ability to create capital growth from the real estate. Is there a good capital growth rate? Does the real estate require a big deposit, or can you use just a normal deposit? And then you've got your interest costs that you have to apply against, obviously, the rate of capital growth. Now, I've done a show on my rule of 10 rate of capital growth formula, but this is what you need. You need a good total return, and you'll end up in a place where you're investing for your future. And really, again, value is what you get, price is what you pay. And remember, trickle-down property theory is a real thing. We want to make sure, if we're buying on a budget, to take into consideration that there are marketplaces available today that are low risk and affordable. We should probably just measure the risk part more, because I hear a lot of people talk about, taking on a cheap property in a high risk marketplace, and unless it's a really good asset, you would be putting yourself in a lot of potential future danger. So we want real estate, which is good, and that has usually intrinsic value, and we can find intrinsic value drivers in all local marketplaces. Even Moree, you could find it. You want natural features like unique landscapes, close to the beach. You want properties with potential for future appreciation through their appeal, their design. Properties which are available, have availability near public transport, good roads, good schools. We want nice, safe, quiet neighborhoods that are lifestyle led. And if you add that to the equation, you can do really, really well from a capital growth perspective. And quite often, again, just remember, if you've got a budget, a limited budget, don't lower those limitations. Spend more, make more in real estate. It's really one of the oldest sayings in property investment. Remember, Rule 72, we want the rate of growth to make us wealthy out of real estate. And again, if we go to trickle-down economics or trickle-down property theory, and we just make a little bit of money to begin with, and then it peters out for a very long period of time, that's not going to get us to our end game of financial freedom. We need a regular rate of growth and a marketplace that has regular returns. And so it's regular, even though it's irregular right now. For example, in Melbourne, to not get a growth rate, that's an irregular thing. Regularly, and if you study the history of capital cities, Melbourne actually gets the most regular amount of capital growth. So it's going through an irregular phase right now, which will sort itself out. It's just after day comes night. It's really going to happen. So again, if we can just make sure that we're putting ourselves in a position to win, and we also, when we analyze real estate, we analyze a risk-adjusted formula. It will really start to click where you should be investing. And that might be a beautiful house, a great looking property in Bendigo, because you've accommodated for the medium level of market risk, but you have put a low level of asset risk in. And I would prefer to invest in a medium level market risk with a high level asset risk, a low level asset risk than, for example, Sydney, where you've got a low level market risk, but you're choosing a really bad asset in Sydney. So make sure the asset does the lion's share of the work, then the market, but put the risk factors together. And so I hope that kind of makes sense. We don't want to be short-sighted investors. We're doing this for the long term. For the most people I coach, they are long-term investors. When I speak to them, what do you want? I want to own real estate for the next 20 years and use it as my retirement vehicle. That is a long-term statement. That is not short-sighted in its perspective. That is a long-term thing. So if we're going to be long-term investors, we want regular growth over a long-term period, and we want the structure of where we invest to be capable to go the distance for the long term. I mean, what I can say about Sydney as well is, like, it's a great example of, a money market which has the monetary value to take real estate up in value. And, often it defies belief just how valuable real estate can become in this marketplace. It's sort of no bounds. And a lot of that is to do with the way the financial industry works in Sydney, and also just the structure of wealth in Sydney. So, hey guys, that's it from me. Let's talk again soon when we catch up on the next episode of The Urban Property Investor. Thanks for tuning in to The Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. I would love it if you could give the show a rating and share it with your friends and family. In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of The Urban Property Investor, take care and bye for now.